You know, that feeling, right? That absolute frustration of watching a perfect technical setup just like completely collapse for seemingly no reason at all.
Oh, yeah. You're looking at the charts, the patterns align perfectly, but the market just refuses to move.
Exactly. So today's deep dive is, well, we're basically handing you the cipher to decode exactly why that happens. We're looking at a really interesting excerpt from your notes, tradingstrategy.txt, specifically lesson 9.
Right, which introduces this very specific quantitative system. It's designed to measure the actual underlying market pressure before the price action even shows up on your screen.
So our mission today is to decode this coefficient cipher. To understand the strategy, we first have to translate these core metrics. So let's just lay out the 3 tiers of the system.
Yeah, the notes break it down clearly. You've got a coefficient of +10 and above.
Which signals strong bullish pressure.
Exactly. Then you have the 0 to +5 range, which just represents neutral market conditions.
Right. And obviously negative values indicate possible downward pressure. It kind of feels like, I don't know, like a financial weather barometer.
A barometer is actually a really great way to look at it.
So +10 means clear bullish skies.
Yeah.
But okay, let's unpack this for a second. If it's really as simple as reading a thermometer, why wouldn't a trader just blindly buy a +10 and sell at 0? I mean, why wait around?
Well, because reading the weather doesn't tell you exactly when to step outside. I mean, you can know a storm is coming or that it's going to be sunny, but the exact timing.
Oh, so knowing the underlying pressure is immense doesn't mean the market is moving that exact second.
Right, exactly. You could have a +10 coefficient for days, meaning the pressure is there, but if you buy in immediately, your capital is just tied up in a trade that's drifting sideways.
Ah, I see.
Yeah, that's why the source explicitly states you have to combine these coefficient signals with technical analysis. The coefficient quantifies the pressure, but the chart patterns and moving averages, they give you the actual trigger.
So technical analysis gives you the exact timing, assuming the market behaves rationally based on that stored energy.
Right.
Okay, but what happens when the mathematical setup gets, completely blindsided by the real world? Like, if the coefficients and the technicals act as the trader's compass, what are the wild currents that can still pull the ship off course?
Oh, well, the system breaks. That is the strategy's biggest vulnerability. The text actually comes with a very strict warning that this coefficient method should never be used as a standalone trading tool.
Because the math kind of assumes a closed system, right?
Exactly. It's calculating internal market dynamics.
Yeah.
But massive external forces, things like sudden shifts in economic policy, geopolitical crises, or, abrupt changes in global liquidity, they can just override the internal math instantly.
Right, because a central bank suddenly pulling liquidity doesn't really care if your order flow coefficient is a +10.
No, not at all. You could have that perfect bullish setup, the technical breakout triggers, and then bam, a major global headline hits.
So liquidity dries up.
Yeah, and that mathematical signal is instantly invalidated. Markets just don't exist in a vacuum.
Wow, so the macro environment just kicks the door down and rewrites the rules entirely.
Pretty much. It's proof that quantitative models are highly vulnerable to macro shocks.
Okay, so summarizing the ultimate takeaway for you listening,
Huh.
this coefficient system is a fantastic shortcut for reading underlying market pressure.
Oh, definitely.
But it absolutely demands the precision of technical analysis to time the execution. And, well, a healthy respect for those massive global macro factors so you don't get steamrolled by reality.
Exactly. But, as you apply this strategy, there's a really curious gap in the sources rules that we should mention.
Oh, right, the undefined
You-
zone.
The text defines 0 to +5 as neutral and +10 and above as strong bullish territory. But it completely ignores the +6 to +9 zone.
Which is weird, right? Is that undefined area a hidden transition phase where momentum is shifting?
Or is it a dangerous trap? Catching traders who are trying to jump the gun before that strong bullish pressure is actually mathematically confirmed.
That is definitely something to keep in mind the next time you see that pressure starting to build.